Good morning, everyone, and welcome to our first ever Navigating Growth CEO Insights for SMEs webinar. So my name is Joanne Creevy, and I'm a member of the Client Services team at Accountant Online. I'm joined today by CEO and founder of Accountant Online, Larissa Feeney. Good morning, Larissa.
Good morning, Joanne. Good morning, everybody.
So Larissa is a fellow chartered accountant and a lead entrepreneur for Acorns program, as well as a contributor to both the Going for Growth and Ambition programs. Larissa is also chair of the Donegal County Enterprise Board, a member of the Finance Subcommittee of the Atlantic Technological University, and president of the Donegal Women in Business Network. So just a little about Accountant Online. We are a firm of chartered and certified accountants, as well as company secretarials, supporting businesses with their compliance, payroll, secretarial, bookkeeping, and tax needs. We are an award-winning practice, most recently recognised by Xero as Partner of the Year for the 4th year in a row. We offer transparent fixed monthly pricing. Technology and digital processes are the core of our operations. We aim to streamline your accounting tasks, managing them effectively and efficiently and hassle-free for you. So we are experts at providing support at every stage of your business, from managing statutory accounting requirements to providing financial and business services like bookkeeping, payroll, and company secretarial. We're here to ensure your finance operations run smoothly. So over the years, we've carefully assembled a multidisciplinary team of professionals with specialists in areas including corporate and personal taxation, corporate finance, financial management, information technology, marketing, and company secretarial. Accounting Online is a full suite finance and business practice. As we've grown, our range of services have grown with us, reflecting the various needs of a wide and ever-growing list of clients. So today's format is ideal for SME owners and managers and established entrepreneurs. If you're considering outsourcing any of your services to a chartered accountant, it is important to note that the information contained in this webinar is for general information purposes only. For specific information or advice related to your business, you should always consult directly with an accountant. If you do not have an accountant, we'd be happy to support you. I would like to encourage your participation during the webinar, so please utilise the Q&A or chat function to ask any questions you may have for Larissa throughout. And just to have an overview of our agenda for today, we'll begin with a brief overview of our 4 key areas crucial for business growth: hiring employees, financing, profitability, and compliance. Next, we'll introduce strategies to effectively navigate these areas as you expand your business. You'll learn essential steps to ensure sustainable growth for your business. And finally, we'll discuss the importance of partnering with a professional to support your growth journey. So, Larissa, how do you prioritise timing in hiring decisions to align with workload fluctuations, revenue projections, and broader business objectives?
How do you time them, Joanne? It's okay, so before we start, I should just say that, as you said already, this is the first time that we've done this webinar. Yeah. So any questions, it would be fantastic if we could get questions through the next hour or so. That will help guide the discussion and help me tailor answers to the people that are on the call and the businesses that are on the call. So in terms of timing, now, the challenge with growth is, generally speaking, financing that growth. Growth is very expensive, and we'll talk about financing later on in the hour. The challenge with the decisions on hiring is that you ultimately have to have the cash in order to pay. So the workforce planning is very important. Your revenue projections are very important. And understanding your overall business objectives. Starting with revenue projections first. Revenue projections and cash flow projections to understand what exactly is going to happen over the next 12 months in particular. How is this new hire going to contribute to revenue generation? How are they going to contribute to growth Are they going to contribute to growth is always a question that we ask businesses to consider, because sometimes it's still the business owner that is generating the revenue and growing sales. So is it that an additional person is not necessarily going to contribute directly to growth, but they are going to perhaps take some of the burden off the owner's shoulders or off somebody else's shoulders to allow them to generate additional revenue? So it's that consideration of where does the employee fit into the plan? Do they help grow the business, or do they help support the business to grow? And understanding what the expectation is. If they are an employee that is expected to contribute directly to growth, how much do you expect them to contribute to that growth? So, for example, if their salary is 100,000, do you expect that 100,000 to turn into 400,000 in revenue, or 300,000 in revenue? Or what is that expectation? It's about being clear on that before you hire, especially for key employees. Sometimes whenever we hire for support employees, it's very clear we're hiring for somebody to take the burden off us. We're hiring somebody to assist with admin, to assist with some other area of the business, but they may not be a key driver of revenue. If they are a key driver of revenue, though, it's understanding, okay, what does that look like? What do I need them to do?
Thank you for that, Larissa. And what would you say the key challenges business encounter as they scale their workforce, and how can they effectively navigate these challenges?
Well, we always say that people businesses are the hardest businesses, but in reality, every business is a people business as far as I'm concerned, because we all need people in order to grow. Now, the challenges that businesses face as we hire more and more employees, there's many challenges. The obvious one, of course, is the requirement you have to make sure that the funds are there to pay the employees. That's a very basic one. But as well as that, you've got challenges around culture. Are you maintaining the culture that you want? Do you have the culture that you want? Are the people that you're bringing into the business, do they fit in with your culture? Do they contribute to that culture, or do they take away from it in some way? So understanding what your culture is and what you're trying to grow and what you're trying to transition into is important. You've also got the challenge of structure, and processes, because especially if you're going from, a solo entrepreneur or a founder, one person company, and you're hiring people in to take some of the burden off you, then we tend to hire people who we think are like ourselves, and that's always not a good idea. And the more you hire, the more need there is for structure within the business. So things like systems and processes, we talk about that a lot. How do everything has to be systemized. And the reason that we have to systemize our business processes is very simply because, I may know how to do something and you may know how to do something, Joanne. And ultimately we may get to the same output, but we may do it very, very differently. I might not do it very efficiently, you might do it very efficiently, or vice versa. So the importance of writing that down so that we know how we want to get to the output, how do we deliver the service, how do we produce the product, etc., ensures that everybody does it the same way. So those are some of the challenges that we face.
Thank you, Larissa, for that. And just around the action list here that is on the slide. Larissa, do you want to talk around that, or?
Yeah, no, I'd love to. I'd love to. Okay, so first of all, workforce planning, I mentioned that briefly.
Yeah.
That's basically understanding what are the needs of your business in terms of your workforce. Do you have a workforce sufficient to meet the business needs, the needs of your customers and clients? If you are, and every business is different, Joanne, but if you have, for example, a seasonal business that, you've got peaks and troughs, you're not going to want to staff a business whenever it's very quiet. So therefore you've got a requirement to hire, and then hire short-term perhaps, or temporary people. Revenue projections and cash flows will come up a lot through the next hour or so. The importance of making sure that you have that buffer to make sure that wages are paid. It's a very basic one, but it is one that keeps small business owners awake at night. How do I make sure that, or not having the money to pay the salaries at the end of the week or month. Hiring needs with business growth. This is a really, really tricky one. How do you time the hiring to meet the anticipated business growth? And what happens if that doesn't come? Or what happens if the growth is higher than what you expected, and how can your team cope with that? And then technology and partnering with professionals can really help here, because there's a lot of technology on the market to allow you to workforce plan, for example, and obviously for revenue projections and cash flows. And then professionals like like HR professionals will really help with those hiring decisions, and accountants and bookkeepers will really help with putting the numbers together. But ultimately, I would always advise any business owner, if you are in a position where you are new in business or you're in the first few years, if you have objective strategic advisors around you to help you to come to those conclusions and come to those decisions in the best possible, in the most informed way, I suppose. Because, looking forward, you won't know for sure if you're making the right decisions around hiring, but all you can do is give yourself the best chance with the best information.
Thank you so much, Larissa. And I suppose at Accountant Online, we can assist with creating budget forecasts aligned with your business objectives, and helping business understand their financial implications of workforce scaling. So do get in touch if you want more information or support with that. But thanks so much for covering that, Larissa. So on to the next topic. So what are the main differences between debt and equity funding, including traditional loans, venture capital, angel investors, crowdfunding, and grants, and how can businesses choose the most appropriate option for their needs?
Okay. So to explain very, very basic, first of all, the difference between debt and equity. So debt is essentially debt is a loan. It's some type of finance that the company will have to pay back at some point in the future.
Yeah.
So, an overdraft, for example, is debt, right through to hire purchase, to leases, to mortgages, to long-term commitments and long-term liabilities. That's all debt. And it's a very common form of funding a business growth. And there's loads of options out there, which I'll come to in a second. Equity is for those of you on the call who are limited companies as opposed to sole traders. Limited companies can offer equity in the business, and that's a way of getting funding in. So, for example, if I own 100% of the business, I might decide to give away 20% for X amount of money, and that value that I put on that 20% is a value that you may come to yourself, or you may get third party advice on what that value is. Or indeed, an investor may come to you and say, I'll give you X amount for 20% or whatever percent they're interested in. Now, equity is a really tricky one. Debt is almost straightforward. You know exactly what you're getting into. You're borrowing a set amount of money. You're very clear on what the interest rate is. You're very clear on what the repayment terms are. It's very straightforward. Equity is a little bit more gray, because you don't know what's going to happen in the future. So, for example, let's say you take equity in and you're very happy with the amount of money that you get and the amount of percentage of equity that you've given away, and you're happy with that. There's a couple of things that you have to consider. The first thing is what happens in the future to the growth of the business. And if everything goes according to plan, will you have to dilute further? Will you have to give away more equity? Are you valuing the company in the right way? Are you getting the right advice there? Some founders, Joanne, will value their company very high, much higher than what it would be valued on the market. So there's a danger that you do that and then you lose out on an opportunity. You have to be realistic on the valuation. Even if you think it's like, our own homes. We always think our homes are worth more than they may be on the market. It's the same with your company. You're very attached to it if you're a founder.
Yeah.
So you automatically think that you may think that it's worth more. In reality, of course, anything is only worth what someone's willing to pay for it. So, so bear that in mind. So if you need the money and if it's an only option for you, you can end up settling for a valuation that's less than ideal for you. You're also getting into bed with partners whenever you give up equity. And that's something that you have to consider, because you always have to think about exit whenever you go into an agreement like this. If you go in, you have to go in with the end in mind. How do I get out? What's the shareholders agreement? Because whenever you take out the shareholders agreement, things aren't going well, generally speaking. But the shareholders agreement should guide you through the process if things don't go well. Your partners may have ideas for the business that don't align with yours. So I
Mhm.
had a case recently where two founders received investment from an investor, and their goals didn't align. So they had very different ideas on where they wanted to bring the company. So that can be difficult. Your investors may put demands on you in terms of more frequent reporting, monthly board meetings, for example, management accounts, management packs, all of them. It may
Mhm.
add another level of governance to the business, which is not always a bad thing. By the way, that can be a really good thing.
Yeah.
So it's just some things to bear in mind.
Yeah.
Okay, so yes, John.
I was just going to ask, like, what's crucial for business to have a deep understanding of their financial metrics, including the management accounts, cash flow forecasting and budgeting? How can this knowledge empower strategic decision making and long-term financial stability?
If you're going to go for any type of funding, so
Mm.
whether it's debt or equity, whether you're even going to go for grant funding, which, if you were able to get a grant from local enterprise
Yeah.
office, for example, or from Enterprise Ireland, no matter where you get your funding from, if there's third parties coming into your business, this is where knowing your numbers becomes
Mm.
really, really important, because nobody will give you money, whether you're a sole trader, a limited company. Nobody will give you money or will bring money into your business without knowing the numbers and without them understanding the numbers. And they have an expectation, because you're the owner or the CEO or the MD, that you are the one that should be able to tell them what the numbers are. And then they will, generally
Mm.
speaking, they will require that on a frequent basis if they are investors, angel investors, venture capitalists. Those types of companies will require that more frequent reporting. For debt funding, it's more likely that you have to produce numbers, you have to produce a business plan, you have to back up your case. But once you have it, generally speaking, they leave you alone unless it's a lot of money and they have a strategic long-term interest in it. But generally speaking, you get it and they leave you alone. Whereas with equity, they generally keep a more active role in the business. Now, there is silent investors, by the way, who will invest and stay away. But as you can imagine, especially if we're talking about angel investors, those are coming in at very early stages of business. So they're coming into very risky investments. So they really try to make sure that their investment is protected.
Yeah, Larissa, thanks for that. And also have a question here from Danny. He has a new consultancy business working in the construction industry. He's come from a residential property development background and have identified a development opportunity which will require funding to the tune of around 1 to 1.5 million. He's in early stages of planning development with an architect, and as a qualified QS, I have a ballpark figure put together which identifies that the development is a real opportunity if and when funds are available.
Okay, so Danny, I think that you're asking what's the best type of funding for the model that you're setting up. If that's the question, then
Yes, he said yes,
yeah,
Larissa. Yeah.
okay, okay. So in my experience, then that is debt. That is generally debt. From
Mhm.
what I've seen, I have seen investors come in, external investors from out of Ireland come in and invest in construction.
Mhm.
But generally speaking, it's usually debt that I see, especially for that level. It's not a massive, massive amount of money, although I
Mhm.
know it seems like a massive amount of money to you, I'm sure. But from a debt perspective, or from an investment perspective, it's not. So I would certainly look for debt funding first, before you go looking for equity funding.
Okay, hope that's helpful, Danny. And any further questions you can get onto us. You just ask are any banks best options, or are there alternatives for this?
I would always, your accountant would really be able to advise you on this,
Yeah.
because they know you and know your business. But generally speaking, Danny, I would start with the banks. Start with the main
Mhm.
pillar banks. Now, there are other options. There's a couple of great options. Linked Finance comes to mind, and there's a couple of other ones that I just can't recall right now.
Mhm.
But banks will fund you, assuming that you have a history there and you can produce the business plan and the evidence and all of that. And they have the security over the asset, of course, which is a big thing in construction. And that's usually why we see debt rather than equity in construction, because they do take security on the asset. So I would definitely try the banks first. If there's a reason why, um, if there's a reason why you think that the banks won't work, then There's loads of other options, and there's also some brokers in the market that will also help you get the best finance available. So only go to the banks, I suppose, first if you're happy that you've got a good chance with them.
Great.
Okay.
Thank you for that, Larissa. And there is an action list here on the screen as well, if you want to cover that.
Yeah, sure. Okay, so and really from okay, thanks, Danny. Set up a call with your team to bring us together. Okay, super. Look, I'm happy to talk to you, by the way. And I'll, if I can remember, if I can recall the names of those other providers, I'll let you know. So maybe Joanne, you can pass on Danny's email to me, please.
Perfect.
Um,
Yeah.
and I can also introduce you to a broker, Danny, as well. So I'll put something together. Okay, so we're evaluating the pros and cons of each type of funding. This is really important, especially for startups. If you're starting, sometimes debt is not an option. Like if you're looking to start a business, and it's not that it's a risky business, you're pretty sure that you'll get money from it. But there's a reason why equity funding and investment has increased over the last number of years, and it's because the banks are less open to taking a risk on businesses. Like one of our other banks, AIB, they have a motto like "Be brave." Backing business, I
Mm.
think they call it, or backing brave. That's what they call it. But I question whether they really, really back brave. Investors will back brave,
Mm.
because they're willing to take the risk, but they're taking equity in the business. So of course they're willing to take the risk, and they're also happy to lose the money because their investment portfolio allows them to take those types of risks. So consider what type of funding is more appropriate for your business, where your business is at. From a debt perspective, consider things like SPCI, which is Strategic Banking Corporation of Ireland, and they have really great government backed options if you're looking for a couple of 100,000, max a couple of 100,000. There's also debt companies like Microfinance Ireland, which would provide smaller amounts like 20 or 25,000 at really favourable interest rates. So there's loads of options there. Just get advice on what the right one is for your business. Don't be swayed by an investor who is attracted to your business and be flattered to the point that you're giving away excess or more equity than you should. That's what I've seen that in the past as well. Now, the management information, numbers, their financial position and cash flow. If you are at the stage of your business where you are looking for some type of funding, then this becomes really critical. It's critical at any part of your business, of course, I would say that, but even more so if you're looking for funding. Having somebody on your side who's producing those monthly figures ideally will really help you be able to communicate the numbers to third parties in a real way, and help you paint a good picture for your business and help you answer those questions on numbers.
Thanks for that, Larissa. And we can support with those as well, to help businesses navigate those complex financial landscapes and optimize their funding options and achieve long-term financial success. So looking forward to hear from you, Danny, after the webinar. And thank you, Larissa, for that. Larissa, how does a well-defined pricing strategy contribute to the success of a business, and considering approaches such as cost plus, value-based and time-based pricing? And can you provide some examples of how each strategy can impact profitability and client satisfaction?
Okay, so pricing is the one area that I see small businesses struggling with all of the time, particularly if you are in either a competitive industry and selling goods, or if you're any type of service business. It's one area that is really difficult to get right. And so this is why we've included it here, because it is a strategic decision on how you price, where you position your product or service in the market, and obviously it will have a direct impact on profitability. Sometimes small businesses can be swayed by market forces, by competition in the market, and I suppose it is an acknowledgement or an informed decision again, in terms of how you price. So say, for example, if we look at what your strategies could be for pricing. So you could decide to have a competitive pricing strategy where you are literally looking at what the competitor is pricing their services at or their product at, and you're putting it out to the market cheaper. That is a strategy in itself. There's nothing wrong with it. It's just understanding that that is what your strategy is, and going with it. Cost plus is where you're taking the cost of your product or service and you're adding on a margin. So you're adding on a profit element and you're pricing whatever the outcome is, regardless of what's happening in the market, regardless of what your competition are doing. Also equally valid. It means that you're very clear on what your profit element is. So you buy in for 100, for example, you sell for 150. Very straightforward. The challenge with this one is for service businesses. It's identifying what is the cost of your service. I've seen time and time again where business owners don't factor in their own cost, their own time, or they undervalue their own time or their own cost. And that means that there's a real possibility of the product or the service being too cheap on the market. Value-based is a really interesting one. Value-based allows you to price your service. Usually value-based is services and not goods. Value-based will allow you to price your service based on the value that you bring to your customer. So it means that two people don't price their services the same because they value their time and they value their experience and their skills in different ways. This is a really interesting one. I see it a lot for consultants. It means that prices can be high, but they're comfortable with that because they understand the value that they bring. And they're happy to not to please everybody in terms of price and to get some type of kickback from customers in terms of price. They're happy with that. It can be very, very successful. It is hard to scale if you're in the type of business that, you know, a larger business perhaps, it's hard to scale value-based pricing. What I've seen certainly over the years. Time-based is very straightforward. And again, it works particularly well for service businesses. You know, it's very clear you're charging X amount per hour and it takes a set number of hours and you're multiplying one by the other and that's the price you're charging. That can be very straightforward and very transparent for your client. However, they can then argue it is taking you too long to do something. And when you base your prices on time, you're then a slave to the clock, of course. And it also means it's hard for you to get away from, you know, a set number of hours. And you can be, yeah, definitely a slave to the clock. So be careful of that one. Other examples are penetration pricing, where you you set a price to penetrate a market. So in other words, you decide to offer, and we see this all the time, of course, introductory offers would be a good example of penetration pricing, where you're trying to penetrate the market, you're going in at a lower price and you're hooking the customer. And if you think about it, any provider that you pay regularly on an annual basis, they'll start you off with an introduction price to get you hooked. And then of course, you're hooked with them and you're less likely to leave. You know, banks do that, of course, utility companies do that as well. We all will be familiar with those. And the other one, the final one to consider would be price skimming, where your prices skim along the top of the market. So in other words, you're not trying to be the cheapest. You're actually probably happy to be the most expensive on the market. So it's crossing over a little bit with value based. So that's some examples of pricing. My advice around pricing is always the same. It doesn't matter what you do as long as you know what you're doing and it's a strategic decision. And you're not just reacting to the market all the time. That's really, really hard because then, you know, if you're in the type of industry where there's a low barrier to entry and you have new competitors every day, then how do you hold your own and how do you grow your own business if you're constantly reacting to new entrants coming into the market that are undercutting you? So I just be careful of that because there's a major impact on your margins.
And Larissa, how do payment terms play a crucial role in ensuring timely payments for business? And what strategies can businesses implement to optimize payment terms and improve cash flow management?
This is a really good one. This is a really interesting one, I always find. If you're the type of business, and this really depends, every business is different, of course, but if you're in the type of industry that demands that you give credit to your customers, the management of that credit is crucial in growing your business. Contrary to that, if you're the type of business that gets paid straight away, you're very lucky. You don't have to worry about that. So if people are buying online, if they're paying in advance, if they're paying at point of sale, you don't have to worry about it. And that's fantastic. However, if you do give credit, managing that credit is super important. Like over the years, I've seen so many business owners who think they know who owes them money in their head. You know, they can, no, I know who owes me money. I can tell you who owes me money and they list them out, but they invariably always don't know the reality of who owes them money. Having a good system, first of all, is basic here, right? Basic 101 is making sure you have a good system to record who owes you money and how long they owe you money for. That's first, because then at least you have the information, and information is power. The longer you leave money out, lying out with customers, the more it's going to cost you, because you have to fund that somewhere else. So if you think about paying VAT, for example, if you think about paying your employees, paying their PAYE, paying back capital commitments on loans, that's all coming out of money that you don't have because you haven't been paid yet. So that can be really challenging. If you're in the type of business that you can dictate how long the payment terms are, then make sure they're as short as possible. So say, for example, 50% deposit up front and 50% on completion of work, or payment due within 7 days, or whatever the case might be very, very clear. If you're in the type of business that you don't have that power, in other words, you may be working with multinationals, you may be working with government departments, where you don't have the power to say, pay me within 7 days or pay me within 14 days, then that's more challenging. And you have to make sure that you have the working capital behind you to help out whenever this payment doesn't come in. Because if you're working for those organizations, you could be waiting 60 days, you could be waiting 90 days, you could be waiting even longer. I've had, horrendous examples over the years of companies that really struggle getting money in from large organizations. And although it's great business to get, and it's, they're priced really well, you do have to price in the fact that you are paying for some type of facility to allow you to cover the time between actually doing the work and getting paid. Now, once all those are in place and you know what your terms are and you're happy with them, then you need to make sure that you have an effective process in place for credit collection. So whether that's a credit collection team, or whether it's software, or, in our case, Joanne, it's a combination of the two, where we bring the two together and we use software and a team. And then that gives them best chance of success. And there's an effective focused approach to collection. So thanks, Joanne. You have the action list up there. First of all, complete the cost analysis. This is back to pricing. This is understanding, okay, how much, what are my direct costs? What are my indirect costs? Your direct costs are your materials and labor that are directly attributed to the sale. So if you're selling a candle, the cost of making the candle is your direct cost. And indirect costs is all other expenses that contribute towards you running your business. Back to payment terms again. If you are, as I've already said, establish the payment terms with your clients to ensure timely payments, and use software like Xero, for example. Chaser's another one that will help you chase payments automatically. And what I've seen over the years is a reluctance for business owners to follow up on chasing that money. There's perhaps a fear of damaging relationships. There could be a fear of not getting further work. And that can be very difficult because you have to balance that with the need to have cash in the bank. Cash is king, remember. And if we don't have cash flow, it can really strangle the business. So I wouldn't say not to make those calls. I would, of course, say to be aware of those relationships, but sometimes having a professional team in place there to make the calls on your behalf can take some of the pressure off your shoulders.
Thank you, Larissa. And if anyone has any questions or anything, do pop them into the Q&A and chat. So, Larissa, on to compliance. And what are the key compliance requirements for businesses, and how can businesses ensure they can stay compliant while effectively managing their operations?
Okay, so from a compliance perspective, businesses have to worry about, and this is the main thing that's in a business owner's head whenever they start a business. And then once the business owner is happy that the systems are in place, it becomes easier to manage. Essentially, you've got to consider, first of all, how you structure your business, whether you structure your business as a sole trader or as a limited company. And Joanne, we do have a webinar every month on this topic. So you might pop up in the chat when the next one is, in case there's anybody on the call who was at that stage. For the purposes of this webinar, I'm going to assume that everybody is a limited company. So a limited company, you have a couple of considerations. You've got to make sure that your filing requirements with the Companies Registration Office, so that's the CRO, are met. CRO, you have to file once a year. You have to file an annual return once a year. If you don't file an annual return with the CRO, you are fined, and you have to be audited. If it's your first annual return, you don't have to be audited, but after that you do. If you continue non-compliance with CRO, they will strike off the company. So that means that the company no longer exists, and that is a dreadful situation to be in, because then you have to pay to get it reinstated, and that's expensive. It does mean sometimes getting a barrister. It does mean perhaps going to the High Court. The tricky thing for business owners is if you find yourself in that position, any assets, this is the bizarre thing, any assets that are in the company when the company is struck off, the Department of Finance and the Minister for Finance becomes the owner of those assets. So if, for example, you happen to buy a property through the company and something happens, then the company doesn't meet its filing requirements and the company is struck off, then that property becomes the property of the state. And then you have to go to the High Court to get that back. So that's, scary, I suppose, to say the least. If you have a limited company, make sure that your CRO deadline is in your calendar. If you have a company secretary or an accountant, they will more than likely take care of it for you. But remember that it is your responsibility. You can outsource the task to us or to any other provider or professional, but it is the business owner's responsibility. And if you do go to the High Court or you do go to try to appeal a penalty, saying the accountant didn't do it isn't an excuse. It is always the responsibility of the director of the company to make sure it gets done. Okay, so moving on to filing, then to tax filing. So if you have a limited company, you have a tax return to file every year. You have accounts to file with revenue commissioners. And I should say, by the way, before I move on to revenue, with the CRO, whenever you file your accounts with CRO, those are a matter of public record. So those accounts can be downloaded by anybody else who pays $250 to do it. So it's done a lot. I mean, if anybody's checking your company out, going back to the investors for a moment, they'll be looking at the accounts that are on CRO. If you're looking to sell your business or you're trying to build a company up for sale, then your potential buyers are downloading your accounts and looking at your balance sheet. And they can see from the balance sheet how much money you're making in terms of profit. They can see how much salary you're taking out if you're a director. They can see what your tax obligations are. They can see who owes you money. And they're obviously in a good position to compare your balance sheet with others within your sector and within your industry if they are looking to see, okay, are these guys a good bet for investment or are they a good bet to purchase? Okay, back to tax filing then. So with the revenue commissioners, as a limited company, you have to file a tax return that has your set of accounts on it. Now that is confidential. Nobody can see that. The relationship between you and the taxman remains confidential. They get submitted once a year. Now, what Revenue do in the background is Revenue have a fantastic IT system themselves, and they do a lot of comparison checking. So they would look across sectors, across industries, across different sizes of businesses, and any businesses that are flagged as being unusual in whatever metric they're looking at will be audited. So, for example, if we were talking about gross margins, for example, so gross margin being the amount of money you make between the sale of your product and the purchase of your product. So that gross margin is the difference between it and net margin. Net margin takes into account your costs, the remainder of your costs. Gross margin is a key performance indicator for revenue. So the gross margin, if you have a bar, for example, on the west coast of Ireland and a bar on the east coast of Ireland, comparing the two, their gross margins should be the same. Even allowing for differences in pricing between the two locations, even allowing for differences in the cost of doing business in the two locations. Generally speaking, the gross margins will be similar. So you can see where revenue would pick up on margins, for example, that may be out of whack or out of kilter with others within the sector, and they will then audit those businesses. And they do that across a range of metrics, all down through your P&L and all down through your balance sheet. They look at your compliance on VAT, they look at your compliance on payroll, they look at your margins, they look at your debtor days. So in other words, how much money is out with debtors and how long does it take you to get it in. They look at all those metrics and they form a picture of your business. And because it's a self-assessment system, revenue rely on us as business owners to submit the correct information. And then they use the data that they have to best understand who they need to target for audit purposes. And then they target those for audit purposes to figure out, okay, what's going on in your business and why is it a little bit different than others within your industry? And hopefully you'll be able to answer those questions. And certainly that's where you have an accountant in your corner, because an accountant will first of all have checked, and there's loads of reasons why numbers may differ. And there's loads of plausible explanations why your margin may be up or down. But you have to be able to explain that, of course.
And Larissa, what are the potential consequences? I suppose you did touch on that already around the non-compliance for the business, and how can a proactive compliance measures prevent these risks, I suppose, such as having an accountant or a company secretary in place for your business?
Yeah, absolutely. So first of all, I would repeat again that it is the responsibility of the directors, as
Yeah.
always, to make sure that the responsibility lies on your shoulder to make sure that the returns are completed. And it is always the director or the company secretary that signs the returns on your behalf. In the case of revenue, it's always the director that signs the returns. So even if you haven't prepared the VAT and even if you don't understand it, you're still signing it. So be very aware of that. And that's, where sometimes non-financial business owners in particular struggle, because if you don't understand how the VAT is calculated, for example, how can you be expected to sign off on it, right?
Mm.
So you have to understand it. That's just it. You mightn't know how your team come to the numbers, but you have to understand what they mean, and you have to be happy that they're reasonable. It's very difficult to be happy that everything is 100% correct and every T is crossed and every I is dotted. But you should form a picture, and it should allow you to make a decision that what you're seeing is reasonable and you're happy to sign off on it, because you have to carry that responsibility as a business owner. And that's very difficult. It's okay until something goes wrong. And then it gets very hard because, I mean, as Joanne has mentioned there, there's penalties, there's fines, and there can be reputational damage, especially there can be reputational damage in two areas. If your company is struck off, as I've already mentioned with CRO, that can be very difficult. That's published, and certainly if you have to go to the High Court to try to reinstate the company. If you have a tax issue with revenue commissioners, if you're over the limit to be published, then your name will be published in the tax defaulters list, and the limit is about 30,000, so it's not massive. So it's just to be super aware of that and to do everything you can to make sure that you lower the risk of non-compliance. And if you are a non-accountant or a non-financial individual, then the best way to make sure that this doesn't happen is to have professionals in your corner working for you. And that is a part of doing business, I suppose, that you bring in professionals that are experts in areas that you're not.
Thanks for that, Larissa. And just to cover the action list.
Okay, so definitely create a calendar that outlines your deadlines.
Mhm.
The main one is the CRO one. That's the big
Mhm.
one. So make sure that if you only put one date into your calendar today, that's the date. It occurs every year. It varies for every company, but you can find it on cro.ie if you put in your company name. You can also ask your accountant, they will know it. Put that into your calendar. It doesn't change, and that will at least will allow you to ask the question every year if you don't know already that your return has been submitted and everything is compliant. Again, your tax filing dates, your VAT, your PAYE, and your corporation tax don't change. Those deadlines happen at the same time. VAT is usually every 2 months. And I can't tell you the amount of clients that we have that seem surprised every time VAT becomes due, even though it happens the same time, every 2 months, every month for payroll and every year for corporation tax. Very straightforward. It doesn't change. So if it's in your diary, if it's in your calendar, at least it will remind you. It's not a nice reminder, I know that. I mean, especially if cash is a problem, if you're growing strongly and cash is low, but it's much, much better to be prepared and to be aware of these than getting a surprise. I remember giving a webinar once, Joanne, and somebody said to me that they got a call from their accountant that week, and she told them, I don't like these surprise calls. No accountant, no call from your accountant should be a surprise. If they're phoning to tell you that you owe tax, it shouldn't be a surprise to you. The deadlines are very clear, they don't change. And as I said, numerous times already. It's your responsibility, so make sure you pop it in your diary.
Yeah.
Okay, outsourcing compliance tasks to qualified professions. This is a given in any area of your business. No matter what you do, you're not going to be expert in everything, and you can't do everything. And you shouldn't do everything because it's not the best use of your time. If you're a business owner, you're out generating sales, you're increasing revenue, and you're growing your business. And anytime you take doing administration tasks or tasks that can easily be performed by somebody else, especially if you're not good at them, it's time that you should delegate. So whether that's your bookkeeping is usually the first thing that business owners will delegate, perhaps payroll. It could be admin to a virtual assistant or a personal assistant. Um, the accounts are an obvious one as well, of course, because most business owners aren't equipped to do their final statutory accounts. But certainly, the more you delegate, the more time that you have to run your business. And always remember, but whenever you're weighing up whether you can afford to delegate out specific tasks, if that time that you normally take to do the task, if in that time you can make a sale or generate, double your profit or whatever it might be, it's time well spent. Um, the last point then there we have Joanna's accountancy software. The accounting software, look, I mean, obviously, software has come a long way over the last number of years with automation and everything that goes with it. The accounting industry is no different. Really, anything that you're manually entering into a system or manually entering onto a spreadsheet or manually entering onto a notebook needs to be automated. There's no need for any of that manual entry anymore. We should be scanning our invoices in. The system can read what's on the invoice. The system can tell us where it needs to go. So a lot of that time should be removed from your day now, if you were doing it at all.
And if you are seeking support with your compliance requirements, feel free to reach out after the webinar. Our client services team is ready to provide a customized proposal tailored to your business needs. And Larissa, what happens if I miss a return?
Okay, so I've touched on this, and I'll say it again because it's so important. What we're talking about here again is the company's registration office deadline. So for those of you who have a limited company, you have an annual return date that occurs every year. So for that date, you have to have a return submitted on time in advance of that date. If you don't, you'll have a fine of €100 straight away. And then there's a daily fine of €3 a day that climbs to a maximum, I think, of 1,200 a year or 1,800 a year, something like
Yeah,
that.
1,200, I think. Yeah.
1,200 a year,
Yeah.
is it? Yeah. Yeah. If you don't submit the return, if you do submit it, you pay the fine and then you're audited for 2 years. Now, most companies have no requirement for an audit. If you have revenue of over 10 or 11 million, you have to be audited. But generally speaking, the vast majority of companies in Ireland are not audited. So if you've missed that return and then if you miss filing that return and therefore you have to be audited, that's an extra expense that really you could do without. Not only is it an extra expense, but it takes time out of your work and it takes time away from your business. An audit can cost, audits are quite expensive. Audits can cost anything from 1,500 or 2,000 upwards, and you will have to get that done twice. Now, and there isn't a lot of firms in Ireland that do audits anymore. We don't do audits, but there are some that do. And it is, as I said, it is a little bit of an admin nightmare to get it done. So my advice would be, again, make sure that date's in the diary. Make sure you've got somebody in your corner, professional, whether that's a company secretarial firm or your accountants, know what that date is so that they'll make sure that they'll get ahead of it and they'll have it submitted for you.
Thank you, Larissa, for that. I suppose your feedback is extremely valuable to us. It not only helps us improve our webinars, but also allows others to discover the same value you experienced today. So if you found today's webinar insightful and believe others would too, please take a few moments to leave a Google review and I'll pop the link in the chat. Just wanted to introduce another webinar that we're currently doing that you may be interested in. So Tom Francis, head of our accounting at Accountant Online, provides an insightful webinar on tax saving strategies for SMEs. So you can discover often overlooked areas in company accounts that can result in significant tax savings, and also to learn about more informed financial decisions. So I'll also put in a link if you'd like to register for that webinar. And even on our events page on our website, there's lots more webinars there that we have planned for the future ahead. So just to give an overview how we can support businesses in various areas, including company formation, company secretarial services, annual accounting compliance, end of year services, as well as online bookkeeping and VAT services. So if you would like further, or if you have further questions or interest in learning more about our services, do get in touch. So the information is there on the screen, and we will send a recording of the webinar today as well as the slides. So if anyone has any questions regarding the topics of the webinar today, do put them in. Larissa, is there anything else that you would like to sort of cover or recap on?
No, not at all, Joanne. Just to say that if anybody does have any questions, feel free to ask them or to email us directly. The email's on screen there, and we'll do our best to answer. It's always very difficult in webinars. We try to give a general, I suppose, a general overview of the major issues and the main issues that we get asked about all the time. But every business is different, every industry is different. And every individual is different. You know, sometimes I see it a lot where you have businesses that look quite similar, but they're run by very different individuals. And I think as business owners, we just have a responsibility to know where the risks are and how we can perhaps trip up unbeknownst to us. And ignorance is no excuse in these situations, and it is quite difficult. But we can't use ignorance as an excuse not to be compliant. So again, as Joanne said, please do reach out. We're happy to talk. We're happy to answer any questions that you have. And we're happy to support you if you need that support.
Yeah, so that's great. So thanks everyone, and hope everyone has a lovely day, and do get in touch. We'd be happy to discuss your business needs. Any other questions, just get in touch with hello@accountantonline.ie. And thank you very much to Larissa for sharing your valuable expertise throughout the webinar.
Thanks, Joanne. Thanks, everybody.
Thank
Have a good
you.
day. Bye-bye.
Bye-bye.